cost. Now, I want you to be careful because this chapter, this part, is kind of challenging and it has some mathy concepts associated with it. So take it slow, ask me questions, give me a call, drop me an email, and we'll get through this together. Now, up to this point, we've been working with price, and price is a demand-side concept. What am I willing to pay for goods and services at a specific time? Now we're going to start dealing with supply-side concepts, but first, we've got to make a few assumptions. Remember, assumptions are rules that we set up and then set in stone with the CP Ferry so that the models will be able to be examined without all the other noise and stuff. We have to make 4 assumptions about consumers on the demand side before we start looking at how suppliers will meet those demands. The 4 assumptions: that consumers are rational. They act in their rational self-interest, RSI, so they get what they feel is most out of what they're doing. This assumes the consumer has considered their actions beforehand. It also assumes that what is best for the consumer might not at first glance be what an expert would be considered best for that consumer. So it's what they feel is in their best interest as they perceive it. Second assumption is that consumers have unlimited wants. Given the opportunity, consumers would get the best and most of everything. I wouldn't drive a Forester, I'd drive myself an H3 Hummer. Given the opportunity, I'm betting that you would choose to go to Harvard rather than come here. Third assumption is that consumers have to incur costs in order to consume. Everything has a cost, both real and opportunity, and consumers have to bear the cost of that consumption. This is a concept called TANSTAFL. There ain't no such thing as a free lunch. Even if you go to Costco for the student lunch program, you go in, you have to pay a membership to get into the store in order to get the quote-unquote free samples. Finally, consumers have limited resources. We don't have everything we want to obtain the things that we need. Now, you might want to take 21 units of coursework in college so that you can get out of school faster, but your resources are limited. You don't have that much cash to spend on books, you don't have that much time to spend on study, and you probably don't have that much energy to do well in 21 units of classes, as well as do everything else that's in your life. Cost side. Cost is what is given up to obtain something else. It's not necessarily money-based. There are 2 broad types of costs involved in economics. The first type of cost is called explicit costs, or real costs, or accounting costs. 3 ways to say the same thing. This is the actual out-of-pocket outlay for goods and services, and that's easy to figure out. Keep your receipts, add them up, you know what your real costs are. The next is implicit costs, or opportunity costs. This is the cost of the next best option. What did you have to give up in order to get what you got? What's your time, effort, and energy worth? Now, total cost is a concept that, because of opportunity costs involved, is theoretical at best. We can save the receipts, but how do we determine the opportunity cost? Think back to my vacation in LA. Each person decides the opportunity cost for themselves, and this is going back to what we talked about just recently. People will act in their rational self-interest. They will take actions that they perceive to be in their best interest at the time. Subjectively, RSI decisions have low opportunity cost because you're doing something that will ultimately benefit you down the road, like taking college classes. Coming full circle, the whole concept of supply and demand and markets and RSI and elasticity, all of these things are leading to the ultimate end result, making a profit in business. Getting back to the donut shop. Now, my donut shop is expensive. I had to put a lot of the factors of production into the mix. Land. Where is my shop going to be located? Labor. Who works there? How many people work there? What are the hours of people that work there? Am I open on Sundays? Capital. I need machines, display cases, washing machines, chairs, stuff like that. I also need financial capital, the money in cash to buy these things to run the shop. And finally, management and entrepreneurship. Somebody, me, had to have the good idea to make it go. My real costs in the shop are those which I have to outlay. I know exactly how much I'm spending to make donuts. I know how much the rainbow sprinkles are. I know how much the flour and sugar are. I know how much I'm paying in interest to the bank loans. And I'm paying more than minimum wage to my employees because I'm one heck of a nice guy. But opportunity costs are those costs that are kind of harder to quantify. How much did it cost to put the elbow grease into designing the shop? I had to work 18-hour days in the beginning as I had to train and bring my staff up to speed. And I had to get up at 3 o'clock in the morning to turn the alarm system off because I had people who were being stupid in my store. How do I figure the costs of those things?
Now, there are a couple of concepts in your book that are not really well covered, but I want you to know about them. One of them is the law of diminishing utility, and the other is the law of diminishing returns. Both of these work pretty much the same way, and the main takeaway is that more is not always better. So, think of it this way. You're hungry, you eat one pancake, and you get 1 unit of satisfaction. You're still hungry, so you eat another stack of pancakes and you get another full unit of satisfaction. Now, you're still a bit hungry, so pancakes 3 and 4, you're not going to be getting the same level of satisfaction as you did with the first 2. You see on the chart that the level of satisfaction is starting to diminish. By pancakes 5, you are actually losing units of satisfaction. And then by pancakes 6 and 7, well, you kind of get the idea. The question you have to ask is, do you feel the same level of satisfaction with pancake number 12 as you did on pancake number 1? Now, the law of diminishing returns is pretty much the same thing. I have one worker at my donut shop, and that worker can provide 1 unit of work. They can only do so much. I hire another worker, and now I have 2. Both workers can provide the same level of units of work because the shop is big enough, they don't get in their way. But now workers 3 and 4 are beginning to become inefficient because they're starting to get in each other's way. They're not able to provide full units of work. They're not able to be as productive. Now, when I hire worker number 5, things have gotten so crowded, they're stepping on each other, and the total number of work units are actually declining because they're not able to use all of the resources. I've got too many people and not enough resources. And then by workers number 6 and 7, they're either getting in each other's way or they're standing back. They're not able to do work because there's just not enough room. So again, the question is, did you get the same level of work, the same level of productivity from worker number 1 as you would from worker number 12?
Back to the donut shop. Businesses go into business for one reason only, and that is to make money. Even a nonprofit can't stay in business long enough if it continually loses money. Now let's look at my balance sheet. I bring in money. My shop is the closest donut shop in the area. The only closer one is over 2 miles away. My market is stable, my prices are reasonable, and Dutch Bros is right next door. I sell a good amount of donuts daily, and my business is going pretty well. But am I making a profit? I have all this money rolling in, so what I need to do is figure out whether income is greater than outlay. If my expenses monthly are $8,000, and I make more than that, I have made an accounting profit. Accounting profits are only monetary, though. There's the other type of profit, economic profits, where I can either make or lose money. Accounting profits are calculated only on real cost versus real revenue. If I bring in more than I lay out, I am making an accounting profit. But now you've got to factor opportunity costs into the mix and figure out whether the money you've cleared over the past month is all worth it. This is the big slippery one. If I'm running my shop, I have real expenses of $8,000 and I have total revenues of $12,000. That means that I've got a real profit of $4,000. Not bad. But then I've got to count all the mornings that I had to wake up at 3 o'clock and go and shut off the alarm, and the 18-hour days because I had people out with the Rona and all of the other fun that comes of being a small business owner. Is the $4,000 that I've cleared at the end of the month worth it? In business, in anything really, you need to take all of these factors into account and come to the determination of whether it's all worth it. To add to the fun, there is another cost that has to be added into the mix, which are sunk costs. Have you ever heard anybody say, I've sunk a lot of money into that business? Sunk costs are costs that are not retrievable. In my donut shop, I paid for the machines that make my donuts. I bought them outright because in my determination, in my rational self-interest, owning a piece of equipment is going to cost me less in the long run than leasing it. The purchase of that machine is a sunk cost. I own it, it's mine, and I can't trade it in. If the company comes out with a new and improved donut machine next week, I still own the old one because I have converted cash capital to physical capital. I know that this is a lot to wrap your brain around, so let's take a look at a baby sloth for a moment. Okay, here's where it can get bumpy. Short-term versus long-term. Short-term is about 6 months-ish, and long-term is anything over usually a year. The short run is a period of time over which one or more factors of production remains fixed. And in the short run, I'm going to decide how many donuts to make in my current facility. I'm going to be looking at what am I going to do tomorrow. In the long run is a period of time long enough that every factor of production is variable. I'm going to decide whether or not I'm going to buy the new Donut Master 6000, whether or not I'm going to build a bigger store. Looking at the amount of time, short versus long, Torgnuts can determine whether any factor of production or cost is fixed or variable. Looking at the short run right now, minimum wage is a fixed cost. It's not going to raise till the end of the year. My rent on my space is not going to raise until my contract runs out. So those are fixed costs. The variable costs are electricity. It takes a lot more to cool the store in the summer than it does to warm the store in the winter because donuts really want it to be about 67, 68 degrees. And so I'm going to have to really bring the heat and humidity down in the store during the summertime. So that's going to be a variable cost. Delivery charges. Gas prices are not set in stone, so the trucks that bring the flour, the sugar, the yeast, and all of that stuff, even the wild volatility in the rainbow sprinkles market, all of these things, in the long run, every cost and every input is variable. I only have one store, and it's next door to Dutch Bros. I'm a small business owner, and I have limited resources, mainly time and money. If I turn every donut machine on and run it at 24/7, I am going to soon reach maximum output. There's no switch I can throw to make more donuts. I can't hire more people to make more donuts. I am maxed out. But as it is now, I only run the donut machines at about 60% capacity, since that number of donuts I can sell in my storefront on any given day. But I have an idea. I'm going to hire someone to deliver donuts to places that are far enough away from my central store to make it more convenient to buy my donuts. This would allow me to turn the knob up to the machine up to about 80% capacity within the next couple of weeks. Production concepts. Total physical product. This is the number of donuts I make all told within a given amount of time, daily, weekly, monthly, whatever, however I'm going to measure this time. Marginal physical product is the number of donuts I can make by increasing one factor of production, adding another worker, building another store, buying the new Donut Master 6000, whatever. But you'll notice that there is a point of marginal diminishing returns built into the marginal physical product. Pretty soon, everybody's going to be getting in everybody else's way, and we are not going to be as efficient in our operation. Now, there are some scary math-like economic concepts with scary alphabet soup things. Total cost is the total fixed cost, TFC, plus the total variable cost, TVC. Page 100 has a really good chart that shows this. If the TFC, the total fixed cost, is 2, as it's shown in the chart, then the gap between the TVC and the TC will always be 2. Marginal cost curves. Remember, marginal means one more unit of production. these next several charts, are all going to break down the costs of production into a per unit basis. You did a marginal cost analysis when we talked about buying a dozen donuts and discarding the rest rather than buying the 10 you needed at a higher price. You also do it in unit pricing. Is it worth buying a smaller jug at a higher marginal rate than it is to buy a larger jug at a smaller rate and throwing some away? The assumptions that we are going to use are here. Again, we've got the CP Ferry. We are going to assume that our output jumps in 100s. We are going to assume that our fixed costs are 4,000, and we are going to assume that our variable costs are legitimate as you see here. Averaged fixed cost, AFC. Simple math. The more you make of an item, the less each individual item costs to produce. The steep drop-off at the beginning could be a result of the initial cost of turning on the machine. If it costs you $250 to turn the machine on, you're not just going to produce 2 items, because those 2 items are going to have a marginal cost over $125. What you're going to do is you're going to maximize your cost, and you're going to make as many donuts as you think you can sell before they all spoil. Average variable cost. Simple math. This is unit pricing. This is similar to finding out 28-ounce jug of jam that costs $2.50 is about 9 cents an ounce, and a 60-ounce jug of jam that's the same jam costs $4.25. That's about 6 cents an ounce. On this chart, we're looking for the dip. We're looking for the southernmost spot. This is going to be the point of greatest efficiency because that's our lowest marginal cost. Average total cost is math. Average total cost is the AVC plus ATC. And you've already seen how we got the average fixed costs and the average variable costs, so we don't need to go back over those. Marginal cost. This again, more simple math. Take the change in TC and divide by the change in quantity. Remember, we are dealing with the change in items. And the red line shows the marginal cost change. You're going to want to see the table on 101 for a more exact breakdown. Now let's follow how we're going to find the marginal cost. First thing we're going to do is we're going to take the first 2 output levels, 100 and 200. Now, my costs, my total cost, the change is 1,000 because I had 7,000, I made 6,000, 7 take away 6 is 1,000. My output changed by 100, so 200 minus 100 is 100. I do the math, 1,000 divided by 100 equals $10 per unit, marginal cost. So far so good, let's do the next one. Again, we're thinking the change in cost. So the total cost, the change, 7,500 to 7,000, now I'm down to 500 total cost change, but I'm still at 100 in output. Doing the math, 500 divided by 100 is 5. Looking good. One more. 9,000 minus 7,500 is 1,500. Again, my output jumps by 100. So 1,500 divided by 100 equals 15. Now, did you notice that my price has begun to go up? As my marginal cost, you fill in the rest of the blank, as my marginal cost from 200 to 300 went down, because of other factors, the marginal costs for all of the others increase. So that's why you see kind of a Nike swoosh in the marginal cost curve. The marginal average rule. Why does the marginal cost curve intersect both the average variable cost and the average total cost at their lowest points? If marginal cost is less than the average cost of all the previous units, making that unit will have the effect of pulling down the average. If the MC is more, it'll make that unit pull the average up. It follows that whenever MC is below AVC, average variable cost must be falling. And whenever MC is above ABC, the variable cost must be rising. This in turn implies that MC intersects the AVC at its lowest point as well. The same is true of the relationship between MC and ATC.